Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host. I am on a journey with you guys to reach financial independence. Every month, our co-investing club gets together. We vet different passive real estate investments. I invest my own personal money in these as my personal investing strategy in real estate. And we get to talk to a lot of different experts as we administer this investment club. And some of those experts we get to bring onto the show, onto the podcast. So today we've brought in Chad Zdenek. He holds 3 master's degrees. He's a licensed general contractor. He's a professional engineer. He's the founder of CSQ Properties. And Chad, as you can probably guess, has his finger on the pulse of real estate markets, not only in his home state of California, but also around the country. He does invest in many different states. So I wanted to talk to you today, Chad, about why this real estate market today is so unique and how investors can navigate it.
Sure, it's a good question. We were talking earlier before the show, and you mentioned it's been a real estate party from 2014 to 2022, and now we're dealing with the hangover afterwards. I like that metaphor. I think there's a lot of truth to that. But I'll start by saying, real estate's always been cyclical forever, and it's always going to be cyclical. But that being said, I truly believe there's money to be made in all markets. The question is, how do you adapt your strategy? How do you adapt your debt? How do you adapt your purchasing to that market to still find good investments to make money in the long term? And we got to remember that real estate is a long-term game. If you're looking to get in and get out in 3 years or even 5 years, like, it's probably not the right asset for you, because even if you have a 5-year target, you might need to extend that time horizon so that you're not selling at an inoptimum time, right? Maybe 5 years isn't the right time to sell, and there's no way that we would know right now. So what I like to do, and I encourage investors to do, is to really look at where you're at in the market and how are you mitigating the risk at that given point in the cycle. So let's talk about today. We're recording this in July 2024. In the last 18 months, transactions are down by 70%, right? I mean, it's really fallen off a cliff in terms of transactions and number of properties that are being bought and sold. And that's a challenge. That being said, there are discounts that can be found right now. The only people that are actually selling, and part of the reason why the transactions are down, is because people are only selling right now if they have to, right? Because everyone knows it's going to go back up, and they're only selling basically if their debt's coming due and they have a cash in refinance, which basically means they need to bring money to the table in order to do a refinance. And they don't either have money to bring to the table, or there's no appetite for it, and they're forced to sell. Those are the people that are selling right now. So you can get discounts on properties right now. I would say anywhere from 15% to maybe 25%, depending on where and what the asset class is. There's definitely discounts that can be had right now. Part of the challenge is a lot of these properties, they're not hitting the open market, right? They're not going to the market. They're being pocket listed. The banks that know that there's a distressed seller or operator, the banks are bringing in people that they know that can close. So as usual in these down markets, cash buyers are in great positions. And banks that have relationships with existing buyers, like, they're reaching out to those people with their properties, or the properties that they're in risk of taking over. Because the last thing banks want to do is take over properties again, like they did in 08,
Right.
09, 2010. They do not want to do that, and they're adamant about it. So they're being very aggressive on bringing people on board that they know can close deals. And the haircut that's happening on these distressed deals is typically the equity side, right? The low end of the capital stack. Those are the first people that take the haircut. And the bank is only worried about getting the senior debt fulfilled, meaning that the main bank loan. That's what they're worried about recovering. And so these deals, although they're few and far in between right now, if you're able to get on the deals, then it could be very good, in the next 3 years or so. What I see happening in the market is, the Fed's been working on fighting inflation. That's why the interest rates went up as high as they did. And inflation has come down significantly, but it's not down to where they want it to go. So eventually, when they do get it to that target where they'd like it to be, then they want to cut interest rates to create this soft landing we've been talking about for it seems like years now.
Yeah.
And that's what they're trying to do. But what's going to happen when they do that is that's going to reduce the cost of debt, which is going to improve the price of the property. In essence, what we call cap rate compression, right? The capitalization rates are going to go down, and the prices, the value of the properties are going to go up, which is going to be very good for investors. So I think overall, it's a really, really good time to be looking at things. If you're able to get your hands on a property, syndications are great for that because they're a bit well connected than single investors. But if you can get your hand on a property, it's like buying in 2012, right? That's what it is. And in 3 years, I think people are going to look back on investors like you and I that are still doing deals, and they're going to say, oh my gosh, you bought in 2024. You're so lucky. How did you know? It's like, well, you don't know it. Like, it's not easy to raise capital right now. There's a lot of money on the sidelines. People are waiting, but the people that are doing it, they're gonna look like geniuses in 3 years. And the last thing I'll mention, going back to market cycles, and this is maybe talking more to the operators and active investors in your audience. There are investors in all types of market cycles, right? 100%, all market cycles, there's investors that want to invest in that time period. So even though things are a little bit slower right now, I can assure you that there's investors out there that understand, they see things differently and they want to invest right now. There's investors that want to invest last year. There's investors that want to invest 5 years ago, right? There's going to be investors in 2 years. There's always people at different points in the cycle that have a different appetite for risk that will always be willing to invest.
Yeah. And, I think you can make a case that, so the whole invest when there's blood in the streets mentality, that the risk of buying right now is actually a lot lower than the risk was several years ago when everyone thought there was no risk, right? And it was just a big party. So yeah, there's been nothing but negative headlines for the last year and a half, 2 years in commercial real estate. But I actually think it's a lower risk time to buy right now, a lower risk time to invest, because we've all been looking at all those negative headlines, and we're all warier about some of these risks. We're all talking about these risks, whereas 2 years ago, 3 years ago, no one was talking about any of these risks. Assets were valued a lot higher. So I actually do think it's a much better time to invest right now. It's a bad time to sell, like you said, but I actually think it's a pretty good time to buy. Chad, in 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
Sure. So I focus on multifamily syndications and self-storage syndications. So basically putting together investment groups to take down larger properties in those two asset classes. And the best way to get in touch with us is a website, is csqproperties.com. CSQ actually stands for Challenge Status Quo, or anyone on social media is at CSQ Properties.
Awesome. Well, Chad, thank you so much for joining us today. And guys, if you enjoy these quick hit conversations that we have, please rate, review the show. Makes a world of difference to us. And on that note, we will catch you next time. Wondering how private equity real estate investing works? We get it. A lot of investors are put off by phrases like private equity or real estate syndication, but these completely passive investments are actually a lot easier than buying properties directly, buying properties yourself in your own name. So we offer a free 40-minute class called Hack the Rich, 7 Secrets We've Learned from Private Equity Real Estate. There's not even a sales pitch at the end. We'll show you how to invest in these on your own without any help from us. So go to sparkrental.com/hack to take the free class. And we can't wait to chat about your questions.